Welcome to Cut to the Chase. Today is Tuesday, the 1st of July. I'm Daniel Lam, your host for the podcast. Last Friday, the S&P 500 index finally broke above the intraday all-time high in February, due to factors such as the subsiding of geopolitical risk, steadily de-risking on trade tensions, and hopes of a more dovish Fed. Now, times like these, the FAQ that we are hearing would be, do we have more upside still? Well, investors should use the strength to trim excessive long positioning in US equities and rotating into other global equity markets, such as Asia ex-Japan. It is very useful to compare the current rally to previous ones where new highs were made. So the current rally had now exceeded about 50% of such prior episodes. Domestic macroeconomic outcomes is now going to play an extremely prominent role to determine how much room there is left for this rally. Now, historically, US equities can surpass their prior highs by 4 to 12% before topping out if there were to be a 50 or more points increase in the US Economic Surprise Index. Now, as a reminder, the US Economic Surprise Index measures the actual macro data performance compared to expectations. The bigger the beat, the higher the index. This time around, it is more reasonable to lean towards the quote-unquote milder camp in the performance of US economic data. Softer labor market remains a concern. Initial claims have been trending higher. Payroll seems to be trending towards a print below the plus 100,000 versus the plus 110,000 street consensus. Now, moreover, upside risk to inflation is still a concern. The most recent Manheim release suggests that used car prices are likely to jump about 13% on an annualized basis over the next few months. Services inflation, meanwhile, is unlikely to continue benefiting from declines in airfares and hotel prices like we saw in the spring. So this really leaves positioning as the key factor of support in US equities. Currently, investors are still under-owning US equities by historical standard, at minus 0.6 standard deviation from neutral positioning. So all in all, the upside to US equities is getting limited at this stage, although there's also no evidence beyond the potential mild correction in US equities. So therefore, investors should be looking to trim their excessive long positions in US equities and rotating into other global equity markets, which are trading cheaper, such as Asia ex-Japan, Euro area, and Japan. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.